Good day everyone, we are from subgroup 5 and our group with 6 members, me, myself, I'm Chong Li Jing.
I'm Zirong.
I'm Ikmal Azizi bin Hasnuddin.
I'm Muhammad Azrik Dania bin Azmi.
I'm Muhammad Shafi Shakirin.
I'm Anadan Sanmugam.
And now we will start our presentation. Good day everyone, I'm Chong Li Jing. Firstly, I will talk about introduction for our report. The allocated company for our group is TIMECOM. TIMECOM is a telecommunication services provider for both uses of business and home. The two selected competitors are Telekom Malaysia Berhad, in short TM, and the second selected competitor is Maxis Berhad. Basically, three of them are listed company for Bursa Malaysia under the telecommunication and media sectors. Next, justification in selecting companies. Just now I had mentioned, first justification in selecting both of the company is that both of the company are under telecommunication and media sectors, which are the same sector with TIMECOM, and three of them are the listed company for Bursa Malaysia. Second is because the product and services provided with high similarities, so I believe they are highly compatible. Now, I will proceed with company background. First, history of TIMECOM. TIMECOM was established in 1996, headquartered in Shah Alam. Currently, Afzal Abdul Rahim was the CEO of TIMECOM from 2008 until present. Second, company activity of TIMECOM. TIMECOM provides products and services under media and communication for uses of personal, small business, and enterprise. For the personal uses, TIMECOM provides three different affordable connection plans. For small business, TIMECOM offers broadband, voice, and other add-on services. Furthermore, TIMECOM provides a wide range of products and services for the uses of enterprise, including connectivity, security, and etc. TIMECOM with their support team known as Tech Ninja for customer support. Third, market strength. TIMECOM with the market strength of high quality product and services at affordable price and provide customers with high flexibility without signing login contract.
Hello everyone. I will be presenting liquidity ratio. So for the first one is current ratio. Current ratio is the ability of the company to pay short-term obligations to those who within 1 year. Okay, for the time series analysis comparison, based on the graph, the current ratio increased from 1.55 times in 2017 until 2.28 times in 2019. In 2018, TIMECOM's current assets keep increasing, while the current liabilities decreased by 31%. There is a slight increment of current liabilities, but current assets steadily increase, especially in terms of receivables and cash balances. So overall, this indicates that TIMECOM remains strong to pay its short-term debts. Moving on. Next is the cross-sectional analysis comparison. As you can see in the graph, the most liquid company is TIMECOM because of the cash balances and receivables contributes to higher current assets. For TM, the current ratio is 1.33 times. More than one indicates that it is still capable to settle all its debts in the short-term period. However, for Maxis, on the other hand, falls short with 0.53 times, which is less than 1, means that every 53 cents current assets generated, there is 1 ringgit current liabilities in the company. Next is cash ratio. Cash ratio is a measurement for a company to pay back its short-term obligations by only using cash and cash equivalents. For the time series analysis comparison, there is a minor drop from 1.05 times in 2017 to 1.03 times in 2018 due to pay off loans and borrowings amounting 187.2 million ringgit. So from 2018 to 2019, 117.5 million of cash and cash equivalents increased because of strong demands and excellence in collecting cash from their receivables in the short-term period. Thus, this indicates that based on this graph, TIMECOM remains and continues to have performed well, obtaining healthy cash and debt position in the short term. Moving on to the cross-sectional analysis comparison, the most liquid is still TIMECOM. Both Maxis and TM have a ratio below 1. TIMECOM obtained 506,954 million, as mentioned in the previous slide. On the other hand, TM acquired 4,918.4 million of cash due to reduction of capital expenditure, overall cautious spending, and improvements receipts from trade receivable balances. However, their current liabilities have increased for that particular year because of the adoption of MFRS 16. And lastly, Maxis falls short with only 582 million ringgit of cash balances, lower than its current liabilities of 5,607 million, will resulting a lower ratio of 0.1. So I will be passing to the next presenter.
And next is profitability ratio. So under the profitability ratio, there is three margin, which is gross profit margin, operating profit margin, and net profit margin. So first, let's look at the gross profit margin of TIMECOM. So based on the data above, the gross profit margin of TIMECOM increased steadily over 3 years, which is from 51.66% in 2017 to 58.56% in 2019, together with the total revenue. So this is mainly due to the highest sales recorded from the data, which is 72.4 million, in the growth in the data center business, which is almost 5.6 million. So this shows TIMECOM had a good gross profit margin over years, which reflect TIMECOM successfully generating their income. Next, in the cross-section analysis of TIMECOM, Maxis, and Telecom, so we can see that the TIMECOM had a good gross profit margin compared Maxis, Berhad, and Telecom. So this because in 2018, the gross profit margin of Maxis slipped 54.1% from the 2018 due to the weaker service revenue in the absence of network sharing, while the telecom revenue dropped up to 5% in 2019, which recorded the lowest gross profit margin in 2019. So these results, TIMECOM management team did well in managing its cost of sales compared to Maxis and Telecom. Next, the operating profit margin of TIMECOM shows a drastic increase from 2017 to 2018, which is 21.27% to 30.75% in 2018. So this is due to the growth in the pre-tax profit by earning higher overall income, increased cost efficiency, and higher profit share from the investment. But after that, it decreased slightly to 29.65% due to the rising overhead expenses like the interest and taxes in the third quarter of 2019. Next, in the cross-section analysis, so we can see that there is not much difference between TIMECOM and Maxis, which is 29.65% for TIMECOM and 26.62% for Maxis. But Telecom recorded the lowest, which is only 11.37% due to some of the issues in the operating activity, which is decline in the voice service, data problems, and other telecommunication-related services. And besides, Maxis also faced a small decline in the operating profit margin due to the decline in the profit after tax in 2019. So therefore, in terms of the profit margin, still TIMECOM generated profit well by controlling their overall expenses and cost effectively. So the last profit margin under the profitability ratio is net profit margin. So in 2018, the net profit margin of TIMECOM increased sharply from 20.37% in 2017 to 29.35% in 2018. And this is due to the higher earnings in net foreign gain and growth in the data center business. But in 2018, it dropped slightly to 29.19% due to the 10.9 million net forex loss and higher depreciation. So this means TIMECOM had a good net profit margin after paying all the expenses over the 3 periods. So lastly, in terms of the cross-section analysis, Telecom recorded 5.53%, which is better than 2018, which is almost 83% decline in the net profit margin, while the Maxis net profit also up to 33.4%, which is 355 million in the fourth quarter of 2018 from 266 million in 2018. So this growth is due to the strong postpaid growth and high and strong mobile service average revenue. But finally, still TIMECOM made a good net profit margin overall, which indicates TIMECOM generated revenue better than Maxis and Telecom. So to sum up, TIMECOM made a good profitability ratio compared Maxis and Telecom, but TIMECOM maintained a good financial health in the period of 2019.
Good day to Doctor and everyone. I'm Zilong with factory number 172041104. So now I would like to present about the activity ratio that mainly measure about the TIMECOM operation efficiency. So firstly, for average collection period, in year 2018, TIMECOM experienced less efficiency in collecting their debts. This is because based on the graph, we can see that in 2018, TIMECOM using more days comparing in year 2017 to collect their debts. This is because in year 2018, the account receivable has been increased, and this increasing amount of account receivable are actually higher than the sales revenue that have been earned. And also the debts they are unable to be collected also increasing in year 2018, causing TIMECOM to using more days to collect their debts. While in year 2019, TIMECOM are slightly back to efficiency when collecting their debts. This is because the account receivable in 2019 are actually decreasing. However, the sales revenue in 2019 are still increasing. And this increasing sales are mainly came from their new sales of product that been introduced at the end of 2018, and also the increasing sales demands from their group wholesaler and also the global mobile operator. However, when comparing to two other competitors, which is the Telecom Malaysia and also Maxis, the most efficiency in collecting the debts will be Maxis, because based on the Maxis annual report in 2019, the account receivable are actually allocated of 9.96% from their total group net sales. And also Maxis do implement a more secure credit sales policy that they will ensure their customer will pay deposit and bank guarantee for their credit sales. And the second most efficiency will be the Telecom Malaysia, because based on the Telecom Malaysia annual report, their account receivable only allocated 90.63, which is actually higher when comparing to Maxis. And also Telecom Malaysia do allow a more longer credit sales period, which is up to 90 days. As for the total asset turnover, TIMECOM company in 2018 is actually they are more efficiency using their total asset to generate sales revenue, because from the graph we can see that in year 2018 the total asset turnover for TIMECOM is actually 12%, but for previous years is only 11%. So this is because in year 2018, TIMECOM total asset is increasing when comparing to previous year, that causing their sales also increasing. So the increasing total assets is because the newly investment into their international subsidiary in Cambodia. While for 2019, we can say even though it's actually same, but there's only a difference of 0.1% of difference of total asset turnover in 2019, which means that 2019 they actually have less efficiency in using their total assets. This is because when we comparing 2019 with 2018, the total asset in 2018 are actually more higher. However, for the sales revenue generated are actually lower when comparing to 2018. So which means that in 2019, TIMECOM do not fully utilize their total asset to generate a more higher sales. So when compared to two other competitors, the most efficient company that use of their total assets to generate the sales revenue will be Telecom Malaysia. This is because we can see from the graph there, is actually Telecom Malaysia have a highest turnover of 43% because of their higher total asset they own for, and this higher total asset will help the Telecom Malaysia to generate more higher sales. And the Maxis will become the less efficiency company in the total asset turnover. This is because based on the annual report in 2019, we have calculated that only 0.71% of the total asset has been used by Maxis to utilize and generate as a sales revenue.
Assalamualaikum to Dr. Fauzi, Dr. Muhammad Idil, and to my fellow classmates. My name is Muhammad Shafi, and I'll be presenting the leverage ratio. So leverage ratio is the financial tool to measure the financial health of a company, whether it can meet its obligation and whether it's going to go bankrupt or not in the foreseeable future. For the first sub-ratio is the debt to assets ratio. So for the time series analysis, from 2017 to 2018, there is a decrease from 0.26 to 0.20. This is significant, and this is because there is a reduction in loans and borrowings, and this is due to MFRS 15, adoption of new accounting standard. And there is also a small increase from 2018 to 2019 from 0.20 to 0.21, and this is due to an increase in total liabilities from lease liabilities because of adoption of new accounting standard MFRS 16. Overall, the debt to assets ratio is still favorable. So moving on to the next ratio, which is debt to asset ratio for cross-section analysis. So time.com Berhad is the most favorable at 0.21, followed by Nexus Berhad at 0.67, and followed by TM Berhad at 0.74. So even though time.com is the most favorable, but we need to keep in mind that Maxis and TM is bigger than TM.com Berhad in terms of company size. So that's why there is a significant differences. But overall, all of the companies have favorable ratio for debt to assets ratio because it's less than 1. So moving on to the next ratio, debt to equity ratio. So for time series analysis of time.com Berhad from 2017 to 2018, there is a significant decrease from 0.35 to 0.26. And this is the same reason as the previous slides, because of the new adoption of MFRS 15, the accounting standards, which caused the liabilities to decrease. And also, there is a small increase from 2018 to 2019 from 0.26 to 0.27 because the same reason as before, because adopting the new accounting list, which is MFRS 16. Overall, it is still favorable because it's less than 1. Next is a cross-section analysis. Time.com Berhad is still the most favorable at 0.27, followed by Maxis Berhad at 2.03, followed by TM Berhad at 2.9. Well, even though there is a significant differences between Time and Maxis and TM, but it is the same reason Maxis and TM is relatively bigger than Time.com. That's why it's significantly bigger. So finally, times interest earned ratio. So for time series analysis, from 2017 to 2018, there is a decrease from 30 times to 23 times. Well, this is because there is an increase in interest expense because there is a higher liabilities. And the trend continues from 2018 to 2019. It decreases from 23 times to 18 times. Well, even though it keeps on decreasing, but it is still favorable because it's more than 2.5 times, which is the generally accepted ratio risk for this type of risk. So finally, for cross-section analysis, time.com Berhad is the most favorable at 18 times, followed by Maxis Berhad nearly to 8 times, and followed by TM Berhad at 7.4 times. Well, even though there is differences and Maxis and TM is much lower, but all of them is still favorable because it is more than 2.5 times, which is a generally accepted risk for this type of ratio by investors and creditors. So that's all from me. Thank you.
Hello and good evening, Doctor. I'm going to present for the market ratio. First of all, what is market ratio? Market ratio is used to evaluate the current share price of company stock. This ratio is implied by the current and potential investor to determine whether a company's share is overpriced or underpriced. And for my part, I'm gonna do two parts of market ratio, which is price ratio and market book ratio. We can start with the time series analysis for the price per earning ratio. In this slide here, we can see Time.com has a high value of price per earning ratio in 2017, which is 19.37. But it has a great decrease in 2018, which is 11.56. This is due to highest earning per share for the company, which means that the company is more profitable in 2018 compared to 2017, but its market share is lower in 2018. This means that they are trying to attract more investors into their company. The same thing happened in year 2019, but which a slight decrease. but which only a small change for the both factors, which means that the market share and EPS only change a bit. While if we compare to Time.com with the other company in the same industry in 2019, we can see that Time.com has a smaller ratio compared to other company, which is 10.54, while Maxis has the bigger value of ratio, which is 28.76, while the TM has 22.74. This is due to the Time.com only issue the lower amount of shares in the year compared to Maxis and TM, which Time.com only issue 300 million, while Maxis issue 7,000 million and TM issue 5,000 million. From this, we can see that the Time.com is actually has an undervalued stock, while Maxis and TM has an overvalued stock in the industry. Moving on to the second part of the market ratio, the market to book ratio. Here, from the graph, we can see that the time analysis series analysis for the Time.com in the 3 years. During the 3 years, Time.com only spent a small decrease throughout the year, from 2017, from 2.87 to 2.81 and to 2.76, which only a slight decrease of 0.06 and 0.05. This is a good sign to an investor since Time.com kept an almost constant value of a price and market price per share in the 3 years. And based on this graph, we can see that the trend is going to decrease a bit by a bit throughout the years, and it will be a solid investment for the investor to invest on. While compared to other companies in the same industry, the market to book ratio, Time.com only has a small value of ratio of 2.77 compared to Maxis, which is a staggering amount of 70.23. This is 7 times higher than Time.com, while TM is only a 3.88 ratio. This is due to the number of outstanding shares issued by the Maxis is very bigger than Time.com. The book value for the Maxis is only 13 cents, while the book value for the Time.com is 2 ringgit. This means that Maxis has an overvalued stocks compared to other country. But to really confirm that Maxis has the overvalued stock, we have to take account the running return of equity for the Maxis. If the return of equity for Maxis is low, and the price and the market ratio is high, it will be slightly not good for the investor, as it will be a red flag for the investor to invest on. That's all from me. Thank you.
Finally, conclusion for financial ratio analysis from my colleague. Liquidity ratio of TIMECOM is the highest compared to other two competitors and is showing a rising trend for 3 years of period. So TIMECOM with the highest and rising ability of satisfy its short-term obligation. For profitability ratio, TIMECOM with the highest ratio as well, but most of the profitability ratio are showing fluctuating trend along 3 years of period. So TIMECOM with the best performance in terms of profitability, but the increase of profit is unstable. For activity ratio, TIMECOM with the longest average correction period, but the lowest total asset turnover compared to other two competitors. The average correction period and total asset turnover rate is slightly fluctuating over 3 years. Therefore, I can conclude that TIMECOM have a low speed for various accounts to convert into cash or sales, and the trend of activity ratio are slightly unstable. For leverage ratio, TIMECOM with the lowest debt ratio but the highest time interest earned ratio compared to other two competitors. The debt ratio with slightly fluctuated trend and the declining trend for time interest earned ratio over 3 years. So we know TIMECOM with not much capital come in the form of debt. For market ratio, TIMECOM has the lower ratio with the declining trend along 3 years of period. So we conclude that the investor confidence in TIMECOM is low and decreasing. Last but not least, recommendation for TIMECOM. TIMECOM should try to lower down the operating expenses or increase sales to achieve a stable rising trend of profit. For example, TIMECOM can promote their product by holding more promotion and publicity. Besides, TIMECOM can shorten their average correction period to achieve a better view of activity ratio. So TIMECOM can have a better management system to collect the debt more efficiently. Eventually, I believe that the market ratio might be increasing profitability ratio and activity ratio. I getting better because investor will have more confidence in TIMECOM and the market price per share will increase in future. That's all from me. Thank you. This is our references. That's all from us. Thank you for your time and attention and have a good day.